PantheonAI presents Bitcoin breaks $121,000, bank earnings drama, India-US trade deal incoming. Welcome to the PAI Morning Briefing, everyone. I'm John, your host from PantheonAI, and today is July 14th, 2025. Good morning. I hope you're all feeling as energized as the markets are today, because we are diving deep into a truly busy day of developments, big moves, and some incredibly insightful commentary that you definitely won't want to miss.
Good morning, John. And I'm Sarah. You know, you can really feel that buzz in the air, can't you? It's not just the coffee today, it's the market's pulse. I'm ready to dig in.
Absolutely, Sarah. Let's kick things off with a quick, crisp market overview. Our benchmark equity indexes are definitely showing some mixed signals this morning. The S&P 500, for instance, closed its session at 6,259.75, which is a very, very slight uptick, just about 0.065%. So nearly flat, really.
Right. Almost like investors are just, holding their breath, waiting to see what happens next. A real wait-and-see mode, wouldn't you say?
Precisely. Meanwhile, the Dow Jones actually registered a bit of a downturn, coming in at 44,371.51. That's a drop of roughly 0.25%. But over at the Nasdaq, we saw a modest climb, reaching 20,585.53, an increase of about 0.11%. So some resilience there in the tech-heavy index.
That's interesting, given the slight dip elsewhere. And what about the small caps, John? How did the Russell 2000 fare?
The Russell 2000 stood at 2,234.83, down by nearly 0.85%. So a bit more weakness there. But shifting gears to digital assets, Bitcoin is really on a roll today. It's trading at 121,907.328, surging by nearly 2.34%.
Wow, that's a significant jump. And I'm guessing Ethereum is following suit?
You got it. Ethereum, riding a similar wave, is valued at 3,055.36, up by about 2.77%. These marked increases in the crypto space really underscore a renewed investor interest. It feels like we might be seeing the start of another bullish phase in digital assets, doesn't it?
It really does, John. And while these numbers give us that snapshot of today's market pulse, it's so important to dig into the underlying stories, right? The trends that are actually driving these moves. It feels like the equity markets are in a period of cautious optimism, which you just highlighted so well with those mixed signals.
Exactly. Investors are digesting the upcoming earnings season and those shifting geopolitical currents. And those modest gains we saw in technology and digital assets, they really seem to reflect a market that's balancing caution with the hope of continued growth. So let's step into our deep dive on some major market trends brewing this morning.
Sounds good. One of the topics everyone's been talking about this week is definitely the earnings season kickoff, especially from those Wall Street heavyweights. JP Morgan Chase, Citi, Goldman Sachs, they're all under intense scrutiny with their earnings updates on the horizon. Investors are really questioning if these big bank stocks deserve another round of gains after their recent outperformance.
Yeah, it's a narrative that's been repeated quite a bit in the news. And it really highlights a critical juncture where investors aren't just looking at quarterly performances, but also long-term strategies, risk management, and the regulatory pressures these institutions face. It's like running a marathon. Sometimes it's less about the sprint at the end and more about whether you paced yourself correctly from the very beginning.
That's a great analogy, John, and the market's really pondering if this big bank rally can sustain itself in an earnings environment that might not be as favorable as the past. In parallel, international trade dynamics are also capturing a lot of attention. The Indian trade minister just provided an optimistic update regarding the progress of trade talks with the United States.
Oh, that's big news. I heard an Indian delegation is already on American soil, so discussions seem to be moving pretty fast.
They do. And this is significant not just for bilateral relations, but for global trade flows, which have broader implications across emerging markets and the technology supply chain. If these talks lead to concrete deals, we could see some real shifts in trade patterns, potentially easing supply chain constraints in several sectors. It's an interesting dynamic because it's a reminder that global markets rarely exist in isolation. What happens on one side of the world invariably has ripple effects on the other.
Couldn't agree more. And speaking of the banking sector, another major update comes from the domestic front. Huntington Bancshares has announced its acquisition of Veritex, a move estimated to be worth about $1.9 billion. This strategic acquisition, especially in Texas, is expected to really expand Huntington's footprint and service offering in a critical growth region.
That's a bold move, John. While acquisitions like this often indicate underlying confidence and ambition for growth within the banking sector, it also brings up questions about integration strategies, right? And whether similar consolidation trends might emerge elsewhere in the industry as banks look to streamline and scale up their operations.
Absolutely. And on the technology and software front, we've seen Autodesk reportedly drop its potential plans to acquire PTC. Details are still sparse, but the market seems to have reacted with a measure of relief from investors who'd been speculating on the ramifications of a mega deal in the tech world.
Yeah, it appears Autodesk decided the strategic merits weren't as compelling as they initially thought, at least in the current market environment. This decision might reflect a broader sentiment in tech where companies are increasingly opting for organic growth or smaller, more strategic partnerships instead of those huge mergers or acquisitions. It's a good reminder that not every opportunity, no matter how exciting on paper, translates into long-term shareholder value.
That's a really good point, Sarah. And in some personal finance news, FICO has brought a rather quirky yet relevant perspective with the headline, "Treat your credit score with the respect you would treat a lover."
Oh, I saw that one. It definitely made me smile.
Right? The company has announced plans to incorporate buy now, pay later loan data into its credit scoring models. While the headline is playful, on a more serious note, this development could really alter the landscape of consumer credit evaluation significantly. Given the rising popularity of these schemes, FICO's move is an effort to modernize credit assessments and provide a more holistic picture of a consumer's financial health.
Yeah, it could lead to improved credit access and more tailored lending practices, which is great. But it also raises interesting questions about privacy, data accuracy, and how these changes will affect borrower behavior in the long run. It's a big shift. And we can't ignore the political and policy dimensions either, can we? A piece that caught my eye recently was the analysis on Trump's copper tariff.
Ah, yes. The argument there is that while imposing a copper tariff might be seen as a first step, it's by no means sufficient to counter China's growing influence in the global supply chain for critical minerals. The message is clear. America must secure its copper supply chains, yet the window to do so appears narrow.
Exactly. This commentary really invites us to consider the multifaceted strategies required to balance trade relationships while ensuring national interests in critical resources aren't compromised. If governments are increasingly willing to use tariffs as strategic levers, investors might need to brace for a more volatile trade environment in the coming months.
Definitely something to keep an eye on. Now let's move on to some more detailed sector analysis, because I think these stories really highlight some broader trends. In the technology sector, that dispassionate yet resolute decision by Autodesk to back away from the potential acquisition of PTC, that can really be seen as a microcosm of larger trends in the software industry.
It's true. Companies are increasingly weighing the benefits of building internal capacities versus acquiring new ones. And this decision, as you said, not only impacted investor sentiment in tech, but also signals a gradual shift towards organic growth. It's almost like choosing a homemade meal over fast food, right? Familiar, predictable, less laden with hidden calories, if you catch my drift.
That's a perfect analogy, Sarah. On the other hand, it does raise questions about competitive dynamics. Should tech companies try to acquire innovation from outside to remain competitive? The fact that Autodesk decided against it suggests that perhaps the pace of internal innovation has impressively caught up with the benefits of external acquisitions.
That's a very optimistic take. I like it. Moving to the financial sector, big bank stocks are undoubtedly under the microscope this earnings season. With JP Chase, Citi, and Goldman Sachs coming into earnings, we're witnessing a phase of real introspection. Investors aren't content with just a short-term rally anymore. They're rigorously analyzing balance sheets, risk profiles, and forward-looking strategies.
It's like reviewing your expenses after a weekend outing, isn't it? You want to make sure everything adds up before deciding to do it again next time. The focus on these traditional banking giants in an era of disruptive fintech innovations also adds an intriguing layer. Will these titans adapt quickly enough to fend off challenges from agile new players, or will their legacy structures ultimately slow them down?
That's the million-dollar question, John. The coming weeks should offer some real insights. And in the energy sector, while we haven't seen headline-grabbing news specifically related to oil or gas this morning, the broader discussion on global trade and policy measures like tariffs indirectly impacts energy companies too. Disruptions in supply chains or shifts in trade policies can affect everything from production costs to international agreements on energy exports.
Right. In a world where energy demand and supply are in constant flux, even seemingly peripheral policy news can have considerable ripple effects. Energy companies might have to revisit their strategies amidst these uncertainties, and that's definitely something to keep an eye on as the year progresses.
Absolutely. And globally speaking, all these domestic stories are so interwoven with international trends. The swift pace of trade talks between India and the United States, for example, is not only a reassuring sign for those markets, but also a bellwether for global trade dynamics. It reminds us that even as strategic tariff measures, like the copper tariffs we discussed earlier, are implemented to protect domestic industries, they also create an intricate web of international repercussions.
For instance, if trade agreements solidify faster than anticipated, we could see shifts in supply chains that benefit emerging markets and regions trying to diversify their export destinations. This, in turn, might prompt traditional economic powerhouses to reevaluate their strategies, ensuring they remain competitive in a rapidly changing global landscape. Let's now delve deeper into some expert insights and predictions.
I'm ready. What are you seeing?
Well, when I look at today's market data and the unfolding news, a few potential scenarios come to mind. First, that digital asset rally led by Bitcoin and Ethereum, it might not just be a temporary uptick. It could be part of a larger, more enduring trend in the decentralized financial landscape. With regulatory frameworks gradually evolving and growing acceptance among traditional financial institutions, crypto could continue to expand its influence.
That's a big possibility. But we can't get ahead of ourselves, can we? Volatility remains a hallmark of this space, and investors should always be prepared for those inevitable swings.
Good point, Sarah. In the banking sector, something similar is unfolding. On one hand, earnings season might reveal that big banks are holding up well, bolstered by strong asset management and diversified revenue streams. On the other hand, if any one of these banks reports results that fall short of the market's high expectations, we might see a corrective movement in their stock prices. It's a delicate balancing act, much like trying to balance a checkbook after a night out.
Exactly. The narrative isn't just about quarterly numbers. It's about innovation, regulatory evolution, and how these institutions plan to navigate that increasingly complex financial ecosystem. And in the technology sector, the hesitation of Autodesk to pursue the PTC acquisition could really be seen as a cautionary tale. Perhaps it suggests that even well-resourced companies are becoming more prudent in an environment of rapid technological change, where the benefits of acquisitions must be carefully weighed against the risks of integration challenges and culture clashes.
For tech investors, this scenario raises an important question. Should we expect more consolidation in the technology industry, or will a strategy of organic growth prove more sustainable in the long run? From an international perspective, the accelerated pace of trade talks between India and the United States, coupled with strategic tariff measures aimed at safeguarding domestic interests, really sets the stage for a potentially transformative phase in global economic relations.
The big question remains, can countries find common ground in an increasingly protectionist world, or are we headed for a period of heightened trade tensions? And what does that mean for investors who are trying to manage risk in a world where geopolitics and economics interact so closely?
These are complex questions indeed, and they require us to think broadly about our investment strategies. For instance, should investors tilt their portfolios further into sectors that are more resilient to policy changes and trade disruptions? Or is it better to maintain a balanced exposure across domestic and international assets? This is where that blend of rigorous analysis and a dash of humor comes in handy. Sometimes it's all about finding that balance, so you're not riding a roller coaster solo when the market inevitably throws you a curveball.
Speaking of curves and roller coasters, John, I think this is the perfect time for that joke you mentioned earlier.
You got it, Sarah. Why did the stock market break up with the economy? It said, it's not you, it's volatility.
Ha! I love that. In all seriousness, though, humor often provides the best relief in times of uncertainty, and it's a good reminder that while markets can be unpredictable, we can always find a ray of light, even on the most turbulent days.
Absolutely. As we continue our conversation today, let's pivot to a comprehensive coverage of the key stories that are shaping today's market narrative. We have a total of 10 compelling headlines that really deserve our attention.
All right, let's hear them. Lay it on me.
The first major headline revolves around J.P. Morgan Chase, Citi, and Goldman Sachs. As I mentioned earlier, these titans of banking are under the microscope with earnings season kicking off. The repeated coverage of their rallies under scrutiny tells us there's widespread curiosity about whether these banks can maintain their momentum.
Yeah, investors are particularly interested in how these financial institutions are navigating current macroeconomic headwinds while remaining competitive against emerging fintech disruptors. It's a huge challenge. Next,
our spotlight turns to India's trade talks with the United States. The news that the Indian team is already on American soil to negotiate a trade deal is significant. Not only does it underscore the urgency and preparation on India's part, but it also highlights the proactive approach both nations are taking to resolve trade disagreements. This has potential ripple effects across multiple sectors, from technology to manufacturing, and it's a development that might reshape global supply chains.
that's a big one. Our third headline focuses on the acquisition move by Huntington Bancshares as it aims to expand its footprint in Texas by acquiring Veritex. This is a classic example of strategic consolidation in the banking sector, a move that can strengthen market presence during uncertain economic times.
And while mergers and acquisitions always come with integration challenges, such moves typically signal a long-term vision and confidence in regional growth prospects. Our fourth major story is a cautionary piece from the tech industry, as Autodesk reportedly drops potential plans to acquire PTC.
For investors, this serves as a reminder that even the biggest names in technology are constantly reassessing their strategies. It's a tale about risk management and the importance of not overextending, even when an acquisition seems like a quick win. It also hints at a broader strategic recalibration in tech, where organic growth might be favored over potentially transformative acquisitions that come with high integration risks.
Our fifth headline might make you smile again. Treat your credit score with the respect you would treat a lover. FICO is stepping into a new era by planning to introduce buy now, pay later loan data into its credit scoring models.
And while the headline is playful, the implications are serious. In today's dynamic consumer financial landscape, understanding creditworthiness requires a more nuanced approach. By incorporating lifestyle-dependent metrics, FICO is essentially updating its playbook to offer a more comprehensive understanding of an individual's financial behavior. This move could have far-reaching consequences for consumers, lenders, and even the broader financial ecosystem.
Absolutely. The sixth story takes us to the realm of trade policy and global resource management. A recent analysis on Trump's copper tariff reminds us that while imposition of a tariff may be a good first step, it is hardly the end-all solution to countering China's aggressive positioning in the global supply chain for copper.
This piece challenges policymakers to go beyond mere tariff measures and adopt more holistic strategies that secure domestic resource pipelines. For investors, this serves as a reminder of the interconnectedness between policy and market performance. Energy and industrial stocks, among others, could face increased volatility if geopolitical tensions continue to simmer.
While these major headlines cover broad strokes of today's multifaceted market environment, it's also important to note the context in which these stories unfold. Regulatory changes, shifting consumer behaviors, and geopolitical strategies all contribute threads to the larger tapestry of the global economy. Each one of these developments interacts in complex ways that ultimately affect investor sentiment and capital allocation decisions.
That's so true. And on the subject of detailed sector analysis, the technology, finance, and energy sectors are definitely worth a closer look. In technology, that reaffirmation that firms such as Autodesk are recalibrating their growth strategies invites a broader debate on whether consolidation is the order of the day, or if a cautious, organic approach will prevail.
And on the finance side, the earnings narrative around big banks like JPMorgan Chase, Citi, and Goldman Sachs isn't merely about numbers. It's also a reflection of how traditional financial institutions are adjusting their business models in response to regulatory pressures, fintech innovations, and shifting consumer behaviors.
Exactly. And in the energy sector, even though the headlines might be quieter compared to other sectors, the potential indirect effects of global trade policies and supply chain dynamics remain significant. For instance, if copper tariffs lead to supply disruptions, energy companies that rely on copper-intensive components might face unexpected cost pressures.
Now, as we step into the discussion of global market implications, remember that no market exists in isolation. Today's domestic headlines, whether it's the big bank's earnings or Autodesk's acquisition decision, are intrinsically intertwined with international trade dynamics and geopolitical strategies.
The brisk pace of trade talks between India and the United States is a testament to how nations are working to secure strategic partnerships in an age of protectionism. Similarly, policy moves such as the copper tariff are reflective of a broader struggle to balance domestic economic interests with an increasingly competitive and interdependent global market.
For the investor and all of us, these narratives are a reminder to always keep an eye on the macro environment, as global trends inevitably filter down to impact asset prices and market sentiment. Looking forward, what does all this mean for our investment strategies? As we assess the interplay between domestic market movements and global trends, it's essential to remain agile, stay informed, and cultivate an investment approach that is resilient to volatility.
What might be the next big catalyst? Will the earnings reports from major banks exceed expectations, or will caution prevail? And as the digital asset market continues to gain momentum, should we consider a greater allocation to cryptocurrencies in our portfolios? Or will regulatory challenges put the brakes on further growth? These are some truly thought-provoking questions that merit reflection and further discussion.
It's also worth pondering the broader lesson that behind every market move lies a story waiting to be unraveled. Today's headlines, from the cautious optimism in equity markets to the nuanced decisions in technology and the bold steps in consumer finance, teach us that the market isn't just a collection of numbers on a screen.
It's a complex, interwoven narrative that touches upon our daily lives, corporate strategies, and global political dynamics. For many of us, this means that successful investing isn't about chasing the latest trend or relying solely on technical analysis. It's about understanding the bigger picture and making informed decisions that take into account both the present realities and future possibilities.
Before we wrap up today's discussion, I'd like to share some expert insights that have been circulating in the analyst community. Many seasoned investors believe this earnings season could be a turning point for the big banks. With a careful eye on debt levels, revenue diversification, and global exposure, there's an expectation that some of these institutions may surprise the market with robust performance if they provide clarity on their forward-looking strategies.
Meanwhile, in the tech space, executives are emphasizing the need for measured growth over rapid consolidation, prompting a debate on whether technology companies should look inward or seize external opportunities for expansion. And from a global perspective, the fast-paced trade talks between India and the United States are not just routine diplomatic maneuvers. They signal a proactive approach by both nations to secure economic interests in an uncertain world.
As I always say, the key for investors is to maintain a diversified portfolio. With the market brimming with optimism in some sectors and caution in others, it's essential to balance the highs with the lows. Just as a well-prepared chef balances flavors to create a memorable dish, so too must investors balance risk and reward. And yes, sometimes that means being open to a little laughter along the way. After all, market volatility can sometimes feel like a cosmic joke.
It really can, John. So let's summarize our key takeaways for today. First, the equity markets are displaying a mixture of cautious optimism and reserved skepticism. Major indexes like the S&P 500, Dow Jones, and Nasdaq are moving within narrow bands, while the Russell 2000 shows some weakness amid concerns over emerging stocks. Digital assets, however, are on an upward trend, with both Bitcoin and Ethereum garnering notable gains.
Second, earnings reports from big banks such as JPMorgan Chase, Citi, and Goldman Sachs are set to be in focus this earnings season. Investors are scrutinizing whether the recent outperformance of these stocks is sustainable or merely a short-term flare. Third, international dynamics are as critical as ever. The accelerated trade negotiations between India and the United States could have substantial repercussions on global trade policies.
Fourth, strategic moves in the banking sector, like Huntington Bancshares' acquisition of Veritex in Texas, highlight ongoing consolidation trends that are set to reshape regional market dominance. Fifth, the technology sector provides its own set of intriguing stories, with Autodesk's decision to drop a potential acquisition deal sparking conversations about organic growth versus strategic expansion.
And finally, policy measures, notably Trump's copper tariff, remind us of the complex interplay between government actions and market realities. Before we conclude, I want to leave you with a few thought-provoking questions to consider. In light of these developments, are you ready to adjust your investment strategy for the potential earnings surprises from big banks?
How do you view the growing convergence of traditional financial sectors with innovative digital assets? And in your portfolio, what role will globalization and trade policy play in the coming months?
I always believe that learning should be continuous, but it shouldn't feel like a full-time job. So as you reflect on these insights today, remember that you can always reach out with questions to our AI co-pilot here at PantheonAI. Your information co-pilot is always ready to help you navigate these fascinating yet complex market dynamics.
That wraps up our discussion for today's Pantheon AI morning briefing. Thank you for joining us on this deep dive into the market's heartbeat. Be sure to come back for our next episode tomorrow, where we will continue unraveling the intricate tapestry of global finance. Stay curious, stay engaged, and until next time, remember, learning shouldn't feel like a full-time job. Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.